In Chapter 4, Section 2, Basics of Budgeting, I have 2 learning objectives for you. The first one is to identify the purpose of a personal budget and to prepare one. The second is to describe record-keeping methods used in the budgeting process. So what is budgeting? Budgeting is a critical part of managing your money. A budget is a spending and saving plan based on your expected income and expenses. The purpose of a budget is to plan how you will spend and/or save money. A budget is similar to a cash flow statement because both are used to record income, that was the cash inflows, and expenses, the cash outflows. However, a cash flow statement differs because it lists actual cash inflows and outflows to show how much money you have available on a certain date. A budget lists estimated income and expenses to help you create a financial plan. Remember, a budget lists estimated income and expenses to help you create a financial plan. Your goal is to create a financial plan that meets your daily and future spending and saving needs based on your expected income. A budget should be designed to help meet financial goals such as paying for current expenses and saving for the future. To create a budget, begin by looking at the amount you have available to spend or save. Then decide how much of that amount you will save and how much you will spend. You must also choose the items or services for which you plan to spend. Remember that a budget is a plan. Your actual income, saving, and spending may not be exactly as planned. You can compare your actual spending and saving to the budget to see how well you planned. This process will help you create better budgets in the future. There are 4 general steps in preparing a budget. The first is to be able to estimate your income. You may have many different sources of income. Whether the money is earned or unearned, you should keep track of where it comes from and how often it is received. Because most budgets are prepared once a year, you should calculate income for an entire year. Locate the total estimated yearly income amount in this budget figure, and we'll see that that's $2,664. That's the yearly income. See that here? Okay. You may receive income weekly, monthly, yearly, or on some other schedule. No matter when the income is received, it can be accounted for in terms of a monthly or yearly budget. If you receive income weekly, simply multiply the weekly amount by 4 to calculate how much that is per month. For example, $10 received per week would be $40 a month. Rounding is okay as long as your total yearly amount is accurate. If you receive an income once a month, you can multiply it by 12 to get yearly income. When you look at the big picture, how much money comes in and goes out during an entire year, it may change the way you think about money. Going back to the second step, that is planning your savings or pay yourself first. So right now we're on this part of the budget and we're planning our savings. You pay yourself first by putting money into a savings before you consider any other expenses. If you plan what you want to spend first, you may have no money left for savings. Enter an amount that you would like to save. After entering expenses, you may need to adjust this amount. You might not be able to save as much as you want and still pay for all your expenses. Plan to save some money, however, if at all possible. By saving, you will have money to pay for future needs, both expected and unexpected. So if you look at the budget, we see that our example person was able to save $264 per year. That's not a whole heck of a lot of money, but it is a savings. Step 3, we're going to estimate expenses. So we've already looked at income, we've looked at savings, and now we're going to take a look at expenses. Expenses are items for which you spend money: clothes, lunches at school, bus fare. Those are some examples of expenses. You may also make payments on assets you purchase, such as a car. Other expenses are related to living costs and entertainment. Keeping track of what you spend will help you estimate expenses for the future. If you're trying to control expenses, seeing exactly how much you are currently spending for each expense can be quite helpful. Locate the expense amounts in the budget in figure 4.21. This is what we have here. So we're going to take a look at these. So here Andrea has gifts, clothes and shoes, loan payment to parents, lunches, and entertainment and miscellaneous expenses. So there are 2 types of expenses that I want you to understand. They are fixed expenses and variable expenses. The fixed expenses are costs that do not change each month. They're going to be the same, like your rent, your car payment. You know what those payments are going to be every month. Variable expenses are costs that can go up and down each month. An example of variable expenses like your gas or your electric bill. When the weather is cold, the cost of heating your home will go up. Expenses can also vary due to changing prices. For example, as the price of gasoline rises, your transportation expenses will also rise. Other examples of variable expenses are costs for food, clothing, and entertainment. If you have less income or higher expenses than expected one month, you may need to decrease your variable expenses. You may choose to spend less on entertainment. Many people include charitable giving as part of their monthly expenses. Charitable giving is the act of donating money or time to a cause in which you believe. You may donate through your church or a nonprofit organization and through your school. For example, you may donate money to the Red Cross to help earthquake victims. In step 4, we need to balance the budget. And when we're balancing the budget, we're going to find the total savings and expenses, and the amount should be the same as your total income amount. When these amounts are the same, the budget is in balance. If your savings plus your expenses exceed your income, adjust your budget to make them balance. To do this, you will have to lower your expenses, save a little less, or increase your income. Let's take a look at variances. When you prepare a budget, you also want to analyze what you've done. You should not expect income, savings, and expenses to be exactly as you planned in a budget. The differences between planned amounts and actual amounts are called variances. Looking at variances in your income and spending amounts can help you plan better when creating budgets in the future. Variances are the difference between planned amounts and actual amounts. Budget variances can be favorable or unfavorable. A favorable variance occurs when you earn or save more than you estimated or spend less than you planned. An unfavorable variance occurs when you earn or save less than you estimated or spend more than you planned. Let's take a look at some of the examples here. This shows budget variances. So if you look in the first column here, we're going to see the budgeted amount was $222 in income, $22 went towards savings, and $222, so it balanced out for our total savings and expenses. So this looks good, right? So then we look at the actual amount. So she planned to have an income of 120 but only had 110. She planned to have a $40 allowance, but she actually had $50 allowance. So you see where the variances are here? Here we had negative, and here we had a positive, right? So if you look at it, you see a negative of 8% is an unfavorable variance, and a positive of 25% is a favorable. And we go on throughout, especially in the expenses. This you'll see more often in your expenses, the favorable and unfavorable. So take a look at these and make sure that you can identify when it's a favorable or unfavorable expense. Record keeping methods. There are a couple of different ways. There's the manual and the electronic record keeping. You can keep logs or journals on paper that list types and amounts of income, savings, and expenses. Manual records consist of information recorded in hard copy format using pen and paper. You can manually compute your variances and make notations about what to change. You will want to keep these journals over time so you can compare them from year to year. Electronic records. Many people prefer to keep electronic records, which consist of a soft copy format of your financial information stored on your computer. The advantages of using computerized systems include the ease by which information can be updated, stored, and retrieved, and the speed by which new computations and comparisons can be made. There are several available software packages especially designed for financial planning and record keeping. For example, Quicken is a popular financial management program designed to help you keep track of your income and expenses and create budgets. You can also use spreadsheet programs such as Microsoft Excel for data entry and budget analysis. Spreadsheet software allows you to insert numbers and formulas to compute amounts and then easily change them later as needed. You may need to adjust amounts in a budget several times. This can become quite tedious if done by pen and paper. For example, what if your monthly expenses go up by 8%? How will the budget be affected? What if the price of a car you were saving to buy goes up by 10% during the time you were saving for it? How much money will you need for the car? Allowing you to answer what if questions easily is one of the strengths of a spreadsheet program. When you change a number in Excel that is part of a calculation, when you all other amounts affected are updated automatically because amounts are calculated using formulas. Math errors are eliminated, assuming you initially entered the formula correctly. Excel also allows you to set up worksheets and link them together. A sample budget is here on this sheet, and like manual records, electronic records should be protected from authorized uses and users. Passwords and encryption, which is the process of converting data to a coded form, will help protect your information. Also, as with many important files you keep electronically, always keep a current backup of your financial records.